Market structure. Let's talk about market structure. And I know you've come across multiple market structure tutorial, but I guarantee you, I promise you, you've not come across something like this. Because if you have, then you wouldn't identify this as a valid low to take a continuation trade from. And if you have ever been in a situation like this, where you expect market to just come back to that other block, if you trade SMC, expect market to come back to the other block for a continuation trade, what will mostly happen in a situation like that is market will do something like this. All right, a market will do something like that and stop you out, even if your stop loss was right here. And some of you, maybe you watching this video right now would have identified this as this right here as a change of character, or maybe right here as a change. Now let me use something else. Let me go with this. You would have identified this as a change of character and maybe hope to take that reversal trade from here. And it has happened to me multiple times in the past. And what you'll notice is the market will just continue to trade upward. So I learned this from someone else on YouTube on how to read market structure properly to avoid something. At least it will reduce the number of fake break of structure or change of characters that you come across. Because this is for most majority of the market structure tutorial you see online. This is what they tell you: just series of highs and series of lows for downtrend, highs for uptrend and lows for downtrend. This is what they would tell you, but the market doesn't move this cleanly. I mean, if it does, I would probably be, I don't know, a zillionaire or something, if that's a word. I think you too would have made a lot of money off the market. In reality, this is what you mostly come across: something that's not clear. All right, looks so random. This looks so messy, and I mean, because this is this is a this is a new high, but hey, market broke this low and it didn't continue to go down. In fact, came up and created more highs. So how do you avoid misidentifying this as a valid low? How do you avoid that? Well, this is the rule that I've learned to apply in identifying market structure. Identify my lows, a valid break of structure, valid change of character, or a valid low to a valid high. For valid lows, yeah, this right here, there has to be a sweep of liquidity. And I'll make a separate video explaining liquidity in details. But do not just take any down movement and up movement as valid lows or highs. There has to be a sweep of liquidity, meaning for any low that you see, that low is only valid if it sweeps liquidity. Sweeping liquidity means either taking another low or high and before the break of structure. For example, this right here is the break of structure. Yeah, and this is the low that broke structure. Forget about these internal structures here. This is the low that broke structure, and this low swept this liquidity. What am I doing? All right, try and follow up. This low, yeah, swept this liquidity before breaking structure. So this right here is our valid low. This is our valid low. We're not identifying this as a valid low because it did not sweep any liquidity before breaking structure. Instead, this is an inducement. All right, and it's another confluence that I apply to my trades to. I'm going to make a separate video talking about liquidity and inducement. But I need you to understand, for a low to be considered a valid low or a high in case of a downtrend, it has to sweep a liquidity, and the liquidity can come as equal it can come as a trend liquidity, trendline liquidity, or equal low, equal high liquidity. So it has to take out a liquidity before the break of structure, and that is why this is not a valid low. It's not a valid low because it did not sweep any liquidity before breaking structure, and that is why itself became the liquidity that was swept by this before this break of structure. And we can't even consider this as a valid low until the structure has been broken. So this new high, yeah, this big high right here has been taken out. So the idea behind understanding this is, instead of marking something like this, another block, for those of you who trade the SMC, smart money concept, instead of identify this as your identifying an order block from here to take a trade from, you're going to look for this one right here to take a trade from. And in most cases, yeah, I'll show you in the chart. This is on gold. I have a perfect example within there. In most cases, you get tapped in from a viable order or a tradable order block. You get tapped in. So let's assume, I'm going to draw that down. Let's assume we identify our order block from here. We can comfortably put our stop loss below this low, and we're only taking this trade after the structure has been broken, and the idea is to target a new high, which most of the time the markets will just play out exactly that way. The market will play out exactly that way. So the reason we're not taking we're not considering this, the reason we're not considering this as our low to take a trade from is because it did not sweep any liquidity before the break of structure. This is what swept the liquidity. All right, so you can just jump onto the chart and identify every pullbacks as your new lows just because it broke a structure. And now over here is a very recurring example. As you can see, this is a valid break of structure. Why? Because the low had swept liquidity before the break of structure. So this is a valid low, and if we can identify another block from that low, to be a great point to take a trade from. But then we have this little mess right here. All right, I mean, this low also broke structure, right? This low also broke structure, but it did not sweep any liquidity before that. I mean, it made a higher high. It did not sweep any liquidity before that. So we'll consider this as, won't take it as a valid break of structure. And the same thing happened here. This also is not a valid break of structure. It's not a valid low because it did not sweep any liquidity before making this higher high. So this break of structure is not a valid one. However, what it created was a trend line liquidity. And in most cases, what the market will do, is to come back down and sweep that trend line liquidity before the valid structure break occurs. Now, if I head on to live example, well, I mean chart example, it will be clearer. But you need to understand the concept behind, because the market cannot just continue to head to the sky or tank without taking out liquidity. So the liquidities, let's call it the fuel that push the market. All right. So you need to understand this concept that you cannot just mark any lows or any pullback or any highs as a valid high, or any change. You can't just mark any lows or high as a valid high or a valid low. The low or the high has to sweep liquidity. Now it works the opposite way for a downtrend. This is an example for an uptrend, and this is a 5-minute chart time frame on gold. A 5 minute time frame on gold, and over here you can see a very good example playing out. Now if you look at this chart, what you would see is, let's start from here. All right, let's start from here. You see an up movement to create this high, and then there's a pullback, and then there's a higher high. But are you going to consider this as a valid low? You can consider this as a valid low because it did not sweep any liquidity. Let me just summarize this for you. This is what we're seeing right here. This is what we're seeing right here. Right? As you can see, that is not valid because the market came down to sweep it before breaking structure. Okay, so let me take this down so that you can see what just played out right there. So we had the upward move, and then we had this pullback, and then it made a higher high. But like I told you before, this is not a valid low because it did not sweep any liquidity before this break of structure. Hence this whole higher high is not a valid break of structure. So what the market did, was to come down to sweep this low before breaking structure. So we can consider this a valid break of structure. All right. a valid break of structure. That makes this our valid low. All right, that makes this our valid low. And okay, so I went to the 15 minutes time frame to identify a good order block. I'll make another video now to identify a viable tradable order block. So like I said, this is our valid low, and we have a nice order block right here. We have a nice order block right there. I went to the 15 minutes to mark the order block because on the 5 minutes it's a bit messy. On the 5 minute it was messy, noisy. As you can see, now if you consider this, I wish I didn't delete that. Structure. Let's mark it again. This is what we have. We have this, this, sweep, this, this, and it's right here. And then market came back down to tap into the order block of our valid low. All right, before breaking structure. So this is a valid break of structure. Oh goodness. So we usually take our trade from the order block, stop loss confidently below, just to account for spread, confidently below the low, our valid low, and our target is above, is the next high. We expect market take out the recent high. So this is what we have right here. Oh my goodness. Try ignore this. I think I overdrew that nonsense. So this is what we have right here. We have this high, and then this low, and this high, but this is not a valid low because it did not sweep liquidity. Instead, the market came back. Itself was the liquidity. The market came back down to sweep it before the valid break of structure, making this our valid low to trade from. And while the market was making a new high, it created this liquidity. Yeah. So just like in this case, this is the liquidity, and this is our tradable valid low that we're expected to identify our order block from and execute the trade from. That is what happened. Identify our order block, and a market played out. And this is basically what I look out for on the market, on the chart, every day. After getting my buyers, of course, you can't just trade this, execute this to in any direction. You need to work out your buyers. I'll make a separate video on how I identify my buyers. So this is what happened right here. And if you look forward, if you continue to observe, you'll see the same pattern repeating itself. Because let me just clear this out. You'll see the market making this move, a pullback, a higher high, but hey, this is not valid because this is not valid low because it did not sweep liquidity. Instead, itself became the liquidity and market came back to take it out before breaking structure. You understand? So before breaking structure. Now you can't have it play out perfectly all the time, because if you identify this as your order block and you wish to take a trade from there, it's not going to it didn't well, that's okay. This one would I didn't take this trade though, but even though I did, I don't think it would have tapped me in. It was just so close. Yes, it's not going to be textbook perfect all the time, and that is okay. Sometimes you're gonna miss out on trades. It's gonna hurt, but you have to just accept that it's like that sometimes. You just have to take it in. But then again, we see the same pattern playing out here. On this up move, the pullback, the higher high, but it's not valid because it did not sweep right liquidity. Instead, itself became the liquidity and the market came back to take it out before breaking structure, making this, yeah, our valid low, and this is a sweet order block right here. This is a sweet order block right here. In fact, he even made these inducements adding to our confluence. He made that inducement. And again, this doesn't look like a trade. This one of those trade that I will miss out on and I will be crashing out on my bed, because I would like to take my order from the order block. I like to set my order on the order block. Stop loss below, comfortably below the valid low. Targeting the usually I just go for 1 to 3 risk to reward ratio, but when I'm in profit and I feel like I can hold more trade, I go for the recent high. This example is for an uptrend, of course. It works the same way, exactly the same way for a downtrend. And I tried taking this trade. I tried taking this one in particular, and it missed me by few pips. It was annoying, but again, you can only do your part and leave the market to do its part. And this time around, it did not favor me. This was currently I'm on a Pro Firm challenge in drawdown, and this would have been a good recovery, but it missed me. And gold went to do crazy stuff. So what do you do when, because this part of the chart is very clear, it fits into my description of market structure. But what happens if market just goes up like this and doesn't really make that recognizable pattern? What happens? Well, the most recent uh, readable structure was this one. All right, it went up, steady low, went high, and this one came down to sweep the liquidity before breaking structure. Now, what you will notice is this is our valid low. All right, this is our valid low. Now, I didn't take this trade because I didn't see a good order block on an unmitigated order block. I'm going to talk about viable order blocks. I didn't see an unmitigated order block. So, I mean, I wish market didn't pull back to tap into this order block, this one right here. Let me check this out. And let me just put it down. I wish market didn't come back, didn't pull back to mitigate this order block. I would have identify this as my order block and wait for market to pull back. As you can see, market did pull back and it reacted to that, but I didn't take this trade because usually I know other blocks that have been mitigated. Sometimes they work, sometimes they don't. It's a probability game. You can decide for yourself to take other blocks that have been mitigated and see how that works out for you over a lot of trade samples. But let me see if I'm still recording. Yep, I'm recording. But I personally, I ignore other blocks that have been mitigated. So if you're someone who still consider them tradable, well, you would have made profit here. So that is recognizable. This is our valid, this is our recent valid low, and I will not consider this. I will not consider this eh, if you I will not consider this a valid low, this new one. I will not consider it a valid low because even though it had swept liquidity, if you consider this a valid pullback, then you can say okay, it swept this liquidity, but a valid low needs not only to sweep liquidity, it needs to actually take out the recent high, which gold did not do. It didn't take out this high, so it did not break structure. That makes this our most recent low. So if it only makes sense if market should take out that low, we can consider that a change of character, and market did. So when character change, you'll be looking for the sell. Usually when something like that happen, although gold is overall bullish, it has been bullish for a while. I will consider that change of character and look for myself. Although the heavy bullish move on gold, I don't know, I wouldn't be in a rush to look for sales. But yeah, that is it. That is what I need you to understand about market structure and how to identify a valid break of structure. You don't need to just go to the chart and mark every single pullback, every single low, every single high as a valid low or a valid high. So if realistic market behavior on your chart on daily for a trend is confusing, I hope this simplifies it for you a little bit, and you become better at you become better on how to identify market structure the right way.